You're watching Closing Trades right here on ET Now with me, Aisha Faridi. Very quickly on to what the market action has been like. And while we started off a little somber, taking off from yesterday's weakness, of course, it's gotten a little bit worse from there. We're down about 0.3%, about a 100-point knockoff is what you're seeing on the Nifty futures. Having said that, the resistance of that 26,200 level clearly sustains. Time and again, we've hit that mark and softened from there. Right now, what's under pressure is within the liquid universe, names like Bandhan Bank, which have slid about 8%, Emphasis, which is lower by 4.5%, IEX, Pidilite, and Eternal. And mind you, most of these are earnings reactions, other than Eternal, which is down about almost 3%. But on the flip side, BEL is surging higher on account of that order win. That stock is holding up 3.5%. Oro Pharma, Canara Bank for a second consecutive day reacting to its earnings. IDFC First and Union Bank are the ones which are seeing the meaningful moves. But Swiggy, that saw a steady top-line growth, but losses declined less than expected. Meanwhile, Eternal's aggressive network expansion and robust cash position also underline its scale advantage, even as both players show solid momentum in the quick commerce and food delivery segments. So what's the picture between these two QCom giants looking like? Let me take it across to Snehi for that analysis.
Well, yes, let's compare how these two listed food delivery and quick commerce giants stack up against each other, and that is Eternal and Swiggy that we're talking about. If you take a look at their FY26 scorecard, mixed set of numbers coming in from Eternal, wherein revenue was beat, EBITDA was in line with estimates, but a miss on PAT and EBITDA margin. On the flip side, inline revenue from Swiggy, but their losses for their EBITDA and their overall net loss, yes, that has reduced quarter on quarter, but that that reduction has been slightly lesser than what the street would have liked to see. For revenues, Eternal's revenue was up 89.6% sequentially. Swiggy's was up about 12%. And if you take a look at their comparison metrics across their food delivery and quick commerce business, let's start by looking at NOV for Zomato, that's Eternal, and GOV for Swiggy. Eternal's NOV was up 15%, Swiggy's GOV was up 12.7%. For food delivery, Eternal was up 14%, Swiggy up 5.6%. For quick commerce, Eternal was up 27%, Swiggy was not too bad at 24.2%, so right behind that. Quick commerce AOV, this is a very important metric to watch out for because Swiggy has overtaken Zomato in the quarter gone by. For Swiggy, it was 697 rupees per order, and the average order value for Blinkit was 693. In terms of dark store additions for Blinkit, it was at 1816, and for Instamart at 1102, quarter 2 stores added for Blinkit at 272, and for Instamart at 40. So the pace of store addition, of course, is much bigger for Eternal right now than it is for Swiggy. In terms of their monthly transacting users for food delivery, not too much of a difference between them. Monthly transacting users for quick commerce also 20.8 for Eternal and 12 million for Swiggy. The cash balance as of now, 18,314 crores cash on the books for Eternal and 4,605 crores cash on the book for Swiggy. Now remember, Swiggy along with its earnings has also declared that they are going to be mulling a QIP worth 10,000 crore rupees. And in their con call, they've also said that the Rapido stake sale and that realization will come from quarter 3. So a big boost is expected to Swiggy's cash balances as well. So we'll see what that number stacks up like after the QIP and Rapido stake sale amount that's realized. But yes, they are going to make their cash book as competitive as Eternal. So that's the roundup on the quarter 2 earnings from both Eternal and Swiggy. Swiggy seems to be catching up, but yes, Eternal continues to lead on all metrics.
In terms of Zomato versus Swiggy, we believe that there's no reason to go extra bullish on Swiggy, okay, because the numbers obviously were slightly better in terms of the growth on the food GOV side, and even in terms of the losses, even in terms of quick commerce, there was a minor convergence in terms of losses. But there's no reason in terms of why do we see the valuation multiple converging versus Eternal. So I think Swiggy will remain to be a preferred pick. But it will piggyback Eternal in terms of share price performance. So in terms of weightage, what we do is that we still have a weightage of 70-30, with Eternal being a preferred pick and lower weightage on Swiggy. I think what will drive the valuation multiples lower versus Eternal rather, or the market cap discount overall basis, how can that converge? There are 2-3 drivers there. One is I think Swiggy has to expand aggressively, grow aggressively, and reduce losses, which is not happening. So this quarter, if you look at the numbers, there is a minor convergence in terms of the EBITDA losses in the QCom business. But the growth rates don't seem to be compelling in the near term because they've clearly guided for lower store addition. Whereas in the case of Blinkit, they are adding stores aggressively and still kind of reducing losses to a certain extent. So that gives a leeway to Blinkit.
Right. Okay. That's the word coming in on how the QCOM space is actually moving on. And Swiggy, Eternal, both those stocks under pressure today. But let's take the conversation forward. We've got Kunal also joining in on the show. Kunal, hi, afternoon. 26,200, Kunal. It seems to be that very tough resistance zone for, I think, what, 13 months now? We've almost had a hit and trial with that level. Where do you think this cool off or consolidation is going to head?
Yeah, so I think after 26,100, this was the high the index had made in the last couple of days. We are finding it a little bit more difficult to break past about those levels. So this generally indicates that the markets could take a bit of a pause over here for a few more days. Ideally this is what happens. When you meet a very tough kind of a resistance, which becomes very difficult to break. If you don't have support of most of the large cap names, that generally becomes a point where the index starts to go into a consolidation. So I would actually believe that the markets today are sort of indicative that we are likely to go into a zone where we may drift mild negative, maybe a minor correction which could be at play, say another 150, 200 points on the Nifty, try to come back towards a mean reversion around 25,500 mark on the spot levels. But that, I believe, could probably open up a very good opportunity for traders who missed out on the earlier legs, because this typically what happens is when you meet a tough resistance, the market scales down a little bit further from those levels and then tries to prepare itself with a fresh round of sector rotation. So I believe now there could be dual change which could happen to the markets. The movers which were there in the previous leg, the PSU banks, etc., they might take a bit of a pause over here, and you might have some other sectors which could make a comeback. Maybe private sector banking names, the mid-cap end could probably do fare well for itself over the near term, and you might probably expect some of the underperforming sectors like maybe defense, pharma, FMCG, etc., which could try and make a comeback.
Okay, that's the take coming in on the overall market setup. But Kunal, once again, and we've been talking about as to how the smaller PSU and private banking names is where the traction is. And today you're seeing a big spot, be it a Canara Bank, which has run up past 2 consecutive days, be it an IDFC First, which you've liked, 4% higher there, and Union Bank, which is up almost 6% on the futures today. Any trade here, even after these big moves?
So, as I said, PSU banks, I'll be a little bit more selective over here because it's become an easy trade. And we've seen that markets generally don't reward easy trade for a prolonged period of time. And it gets into a phase where you might see a correction which could probably happen into the space over the near term. So I would probably avoid the PSU banking names as of now. And even the hourly charts suggest that maybe the likes of Canara Bank, PNB, etc., they're coming into a slight overbought territories on the RSIs, individual RSIs. But IDFC First Bank could be a different case altogether. I think the stock has opened up a very good opportunity of covering up a huge round of underperformance. And, I think the underperformance was not just the last 12, 13 months, but for IDFC First Bank, this was almost like a 3-year underperformance when the stock had come closer to 9,900 levels. And from there, the stock had gone through a 40-45% correction, came back to 55 odd mark. So it's trying to reverse the entire major correction over the last 3 to 4 years for itself. That, I believe, could be a very good opportunity for short-term traders. My expectation is that hopefully in this leg of uptrend positionally, the stock may hit levels closer to 88 to 90 over the very near term.
Okay. So Kunal, what stocks would you recommend to trade today?
So yeah, IDFC First Bank apparently is one of the stocks which I would recommend even at current levels. My belief is that after this breakout, you might expect positionally that the stock could head towards levels of 88. So traders who are looking for a fresh buy could trail the stop losses to 78 for IDFC First Bank. The other stock which I would recommend would be BEL. As I was mentioning, that there could be a play of sector rotation. And defense, for example, the larger cap names have underperformed in this last 2-3 weeks. So I believe that could make a very strong comeback. We've seen BEL breaking past our resistance around the 410, 420 range. So would look out for targets in the range of 444 and stop loss to be kept at 414.
Okay, on that note, let's take a very quick break. When we come back, we'll of course address all the other newsmakers and how you should be looking to trade and invest in them.
Back with closing trades, and we have the numbers of Maruti Suzuki flashing on the bottom of the screen. It seems like a miss on the profit number. The profit has come in at 3,293 crores versus our poll of 3,458. We'll hold on for more updates and pivot right back to those numbers. But before that, while we're talking about autos, first of the month tomorrow, which means it's that time of the month where we take stock of how auto companies have performed. The industry saw an uptick in demand in October following the recent GST cuts, with stronger momentum across PVs and CVs as well. My colleague Shrishti is joining us with what to expect. Shrishti.
Well, October month marks the first full month wherein the GST rate rationalization benefit will kick in, and along with that, we have also seen that festive cheer all throughout the month with some auspicious days as well. All of that is expected to reflect into the numbers. Firstly, let's tell you the broader expectation from the passenger vehicle space. It's a low to single-digit growth that we are expecting. Commercial vehicle is expected to see a slight decline on a YY basis, while the two-wheeler sales is expected to be just flat. Well, of course, there will be some outliers amongst the segment as well, but with respect to the festive timing, the tractor division is expected to see a bit of a decline. Mid to single-digit decline is what we are anticipating. But yes, if we look at the wholesales data, but along with that, if we also look at the Vahan data, the picture is quite very rosy. Let's take you through the numbers. Firstly, from the passenger vehicle side, with respect to Tata Motors, herein we are expecting a 8% jump on their passenger vehicle sales, while if you see the Vahan data, that is quite very high versus the wholesales data this time around. Maruti Suzuki, similar picture over there, a 4% jump on a YY basis is what we are expecting, while for M&M, a 7% uptick is what we are expecting in their passenger vehicle space. Along with that, Hyundai Motors is expected to post a sales number of 70,000 units. Let's talk about the commercial vehicle segment then. Herein, we are getting to see that on a YY basis, there is expected to see just a mild growth, while on a month-on-month basis, there could be a 15% decline from the numbers for Ashok Leyland. Tata Motors commercial vehicle division is expected to post a number of close to 35,000 crores, while VECV a 2% decline. Two-wheeler segment, herein Eicher Motors Royal Enfield could do really very well despite the fact that there has been no GST benefits. The sales have been very robust. Similar is the case for TVS, Hero MotoCorp, and even Bajaj Auto. Quite very robust numbers is what we are getting to see. And lastly, from the tractor division, because of the mismatch with respect to the festive timings, and well, of course, the focus was on the consumer-facing segments like passenger vehicle and two-wheeler space, the tractor division is expected to show a bit of a decline. But nevertheless, the wholesales data is showing a good picture, but the Vahan retail sales data is showing way higher numbers versus what the wholesale picture is telling. Back to you.
Okay, and Shrishti, we're going to come right back to you to analyze the Maruti numbers, because at best it looks like an inline set. The top line has come in at 42,101 versus what we were anticipating, which was about almost 39,000 or so. The EBITDA, of course, at 4,400 versus the ET Now poll of 4,092 is what they have delivered. Margins flattish, or rather largely in line, I would say, because the ET Now poll was penciling in at 10.25% figure. 10.5% is what they've delivered. The profit is where I think there is a slim beat, because the profits have come in higher by 7.3% at 3293. Of course, for Maruti, I guess a large chunk of the sales would also be in the quarter ahead, given that the GST rationalization benefits as well would accrue, and the festive season sales as well. But Shrishti, prima facie, the first glance, what's the take on Maruti?
Weak set of numbers coming in from Maruti Suzuki, and especially a miss on the margins is what we are getting to see. 10.5% is what the company has reported. That's in line to what we were expecting, but profitability-wise, there has been a miss. We have been flagging off the fact that, yes, of course, there has been a minor gain in terms of the volumes, but because of the fact that the company has spent a lot on the advertising this time around, and along with that, there has been higher discounts that were offered by the company in the smaller car segment, and that product mix overall is likely to impact the numbers, and that's exactly what we are getting to see on Maruti Suzuki numbers at this point in time. There has been a miss with respect to the profit figure. Profit come in at 3,293 crores versus our expectation of close to 3,500 crores. Other than that, in terms of the revenue, 42,101 is what the company has reported. That is in line what we were expecting at ET Now, but operationally doesn't seem to be that great a quarter. So all in all, Maruti Suzuki on the back of the margin miss, and yes, of course, their margin has seen a bit of a decline. We are getting to see that Maruti Suzuki is down almost 1%. We are looking for more finer details, and we'll get back to you.
But in terms of the commentary and the nitty-gritties, Shrishti, what is it that you're looking out for? Because you were anticipating that EBITDA margins are going to be under check because of the higher sales promotions as well as the ad spends as well that they accrued. But what are the volume figures? What are the ASPs that you're anticipating and penciling in your poll?
Aisha, the Maruti Suzuki is indeed the leader in the passenger vehicle space, so the commentary will be very critical to watch out for, given the fact that despite the GST cut, the management did not, the management happened to change its guidance and revise it upwards. But despite the fact, on a quarter-on-quarter as also on a YOY basis, in this quarter itself, we have seen just a low single-digit growth. So going ahead, now that the festive season is over, in the second half, what sort of a volume growth that they are anticipating for Maruti Suzuki and industry will be the critical to watch out for. The other important factor will be the discounts, because by the year end, Maruti Suzuki did say that their overall discounts will be, some part will be through festives and the other latter part will be ended by 31st of December. So post that, what's the visibility with respect to the pricing and the discounts that were offered? That is something that we will be watching, and they also have some new launches lined up, especially from the EV space. More commentary on that is something that we will be watching.
Okay, in fact, let's take the conversation forward. We've got Naveen Kulkarni joining in the show right now to analyze exactly this. Naveen, hi, afternoon. What's the first take on Maruti? Seems like an inline set largely.
Yeah, so if I were to look at numbers, two things. One is the revenue numbers are slightly ahead of estimates. Let's say we were estimating around 40,000 crores and they have delivered around 42,000 crores. So that's slightly higher than what we were expecting. EBITDA numbers are also slightly higher. So we were expecting around 4,200 crores. So they have delivered around 4,400 crores. So that is also slightly higher. Margins we were expecting to be in the range of around, let's say around 10.7, 10.6. That's slightly lower at 10.5. So I won't read much into it because there is, let's say, 10 basis points here and there. Going ahead, of course, it will be interesting to watch in terms of how the new products are doing and what is the let's say the end of the year. Typically Q3 tends to be a little slower post the festive season. How volumes behave and how Q4 will behave, because Q4 probably will be very, very critical, right? So I think management's commentary on the overall demand scenario and how we are likely to close this fiscal year are going to be the key factors for Maruti.
Naveen, so lots to watch out for, but where do you reckon the volume number could have been? Our estimates were at 2%. Now, of course, we're waiting for the press release and the presentation to come out. But where do you believe this volume number could be for Maruti, and how much of an impact do you think the delayed purchases because of the GST cut could have? When do you see that overhang going away?
Yeah, so see, volume numbers typically they report every month, right? So I don't think so there will be any serious difference in terms of the volume numbers. The only critical factor that we need to watch out in the quarterly numbers is the margin performance, right? Because how much they have spent on, let's say, the festive season, whether there have been higher discounts, because there was, of course, the GST overhang, and then there's some this, and there could have been higher discounting during the month. So how that has panned out is critical. But looking at the margin performance, I don't think so there has been any serious negative impact. In fact, the overall EBITDA numbers look to be slightly higher than expectations. So I would say that the margin performance is kind of in line. EBITDA slightly ahead of expectations. Whether this will result in an upgrade in earnings estimate is something which remains to be seen, and that is what we will be very, very critically watching for.
Okay, 16,147, a little bit of a flip-flop happening as the street digests those numbers. But Naveen, what's the house call in the 12-month price target on Maruti?
Sorry, we will not have a target, but see, broadly speaking, Maruti looks to be starting to deliver on the numbers as well as managing its market share better so than what it has been in the last few years. So I think we are in good shape in terms of the new product launches. The model cycle appears to be stronger than what it was compared to last 2 years. And of course, the volume numbers are doing reasonable. And of course, and going ahead, if margin were to improve with operating leverage benefits coming in, I think Maruti can still do well from here.
Okay, Naveen, great to be chatting with you, and thanks for that quick take on Maruti. finally the stock has recovered a little bit and settling in with just a little bit of softness as we speak right now. But we'll take a very quick break on that note. When we come back, we'll...
Great, let's talk about the market. About an hour or so left of trade. We have Mr. Dharmesh Kant, Head of Equity Research at Cholamandalam Securities joining us, and Amar Singh, Senior Vice President Research of Angel One, joining us on the technicals. But let's talk about the fundamentals first. And Dharmesh, give us your reading of the market. You know, it's been quite volatile all throughout today. In fact, we're now even sub that 25,800 mark. According to you, what is causing the pressure on the market right now? Because so far the earnings we've seen, Nifty or otherwise, have not been all that bad. So where are you seeing the earnings this season and the overall market construct going ahead?
Yeah, good afternoon, everyone. I mean, earnings has not been that great. So 25 companies, including Maruti, have reported earnings from the Nifty constituent, and the growth is only 3.5%. And let's not forget, last quarter, same time was a very low earnings base. So 260 was a total Nifty 50 earnings Q2 of FY25. So on background of that, the earnings have not been that great. And if you look at, say, 67 BFSI companies, they have reported earnings growth of 3%, and 24 IT companies have reported earnings growth of only 4%, and that includes the mid-cap IT companies. Outside of this basket, there are a few pockets like renewable energy, cement, or refiners, chemicals, tire companies. They have reported a better set of numbers, but most of them, again, are lacking a good commentary going forward. Like cement companies, very, very skeptical about the growth going forward. And that is the reason I think which is keeping a lid on the market upside trajectory. We are seeing consistent profit taking happening onto the basket. There are definitely some outliers, like Reliance Industries, to my mind, is an outlier to the basket. And banking space, particularly the public and private sector banking space, where we can see our traction going forward. But to my mind, November would be a difficult month for the market. I am expecting around 4-5% kind of a correction happening into the index level. And then based on the management commentaries and hope trade building on, and on-ground dealer checks will take this market forward.
Interesting. So Dharmesh, basis what you've seen on the earnings, what are your biggest overweights and underweights so far?
I mean, the biggest overweight has been banks. So public sector banks, we have been quite bullish on for quite some time, though the stock prices started moving out last 2 months onwards. Otherwise, it was, a slowdown kind of trajectory out there. And the good part about, the banking space has been the asset quality has improved, credit costs has come down, and NIMs are likely to bottom out this quarter. So from Q3 onwards, we should see the NIMs expanding. Subject, there is no further rate cut. So that's the only caveat out there, and the valuations are damn cheap. They are comparable to, private sector banks, where advances growth has been far better than private sector banks. So private sector banks were around 9 to 11% kind of a credit growth, whereas public sector banks were anywhere between 13 to 15, 16%. So this is one space where we are, bullish on. Apart from that, the entire defense space we are bullish on. But that's a structural, decadal kind of bullish stance which we have on the defense space. And metal is another space where we think that this continuity of upside momentum is likely to be there, given the fact that all the geographies across the world are now focused on their internal consumption and development, and infrastructure activity has picked up. So these are the broadly three spaces where I think there would be traction going forward. What we have avoiding and we have become slightly bearish on is the entire automobile space. But that I think will come in for serious profit taking. Say 1st of November, they will be reporting their October sales number. First, it will be coming on a big base effect because last October, both the festivals were in the same month. And secondly, as we have been speaking to dealers, that's noise has been great, but actual pickup has been only 4 to 5% kind of a volume growth, which has been seen, especially in four wheels like Maruti and Hyundai. It would be around 1 to 2%, not much that. And the valuations they are sitting on may call for a good swift trading, profit taking playing on. So selectively, there are pockets where, things are shaping up well, and stock specific, there are ample opportunities out there.
Okay, so that's the take on some of those sectors, not in particular, but let's address the flash on the bottom of your screen. Very good numbers coming in from Shriram Finance this time around. The stock was up 3.5%, but has seen some simmering down from from that high at 2.8% high is where the stock is trading right now. To take you through what the numbers are, the net interest income has come in at 6,026 crores, up about 10.5% year on year, and slightly better than our growth, our estimate of 6,044 crores, so looking healthy on that front. It's the profit number that's come in at 2,307, 3% higher than our estimates at 2,236, and also a year-on-year growth of 11.5%. So healthy numbers on NII and PAT. The asset quality on the GNPA front in line at 4.57%. NNPA has done much better than our estimates at about 2.5% thereabouts. So NNPA also looking good. They have redesignated Parag Sharma as MD and CEO. Remember, he was MD and CFO. So that elevation has happened for them, and now he's become CEO. So that is another positive coming in for the company. They've declared an interim dividend of 4.8 rupees per share. So all in all, healthy set of numbers coming in from Shriram Finance. That's an improvement on metrics on all fronts except the GNPA that has ticked very nominally on a quarter-on-quarter basis, edged up higher, so not much to concern over there as well. But all in all, good set of numbers coming in. Amar, any reading on Shriram Finance on the charts ever since it's entered the Nifty? What has been your take on the stock performance, and what is the outlook going ahead?
Yeah, very good afternoon. So if you look at Shriram Finance, it's on a roll. Honestly, if you see the way the stock has rallied from the recent close of August, from almost 560, 565 levels, currently it's around 765. So it's witnessed almost a 30, more than 30%, 35-40% rally in the last few months, and the stock is trading at its record high. So the stock is displaying strong momentum on the charts. If you look at it, was earlier 700 and 720 that was acting as a zone of resistance. So that has been taken out. So the trend is definitely strong and positive on the short term, on the intermediate term trend, as well as the long term trend. So I would say those who are long, they should definitely hold on to the stock because you're not seeing any drop in momentum as of now. But fresh entry at the current levels might be somewhat not advisable. As far as the support for the stock is concerned, that's around 720, 730 zone. That's an important zone of support for the stock. Those who are long, they can trail it below those levels. And the stock, the way the stock has rallied, if it sustains above 780 odd levels, then it will rally towards 815, 820 levels.
That's the take coming in on Shriram Finance. Just looking at some of the other buzzers, well, of course, it is the smaller banks which are the ones which are, really showing leadership today, be it a Union, IDFC First, Can Bank for a second consecutive day. Some of the pharma names also are making a dash. Look at Oro Pharma, for instance. That's holding higher by 3.5%. We were talking about the defense names. BEL, of course, is the strongest one today, 4% higher. But let's also look at the lagging end of the market. Look at Eternal. That slid about almost 3%. And, Snehi was just making the comparison between Swiggy as well as Eternal. Swiggy also under pressure after its earnings. NTPC, Cipla, you've got an Interglobe Aviation, ICICI Bank, HDFC Bank, Kotak. Some of the metal names as well are taking a bit of a breather today. Hindalco lower by 1.25%. Infosys, Trent, Maruti has now stabilized around that 0.5% of a downtick. Jio Finance, Axis Bank, that's where you're seeing some laggards as well trickle in. Even for the breadth of the market, that's where you are seeing the laggards too. Bandhan Bank has now slid a good 80%, or rather 8% actually. Emphasis is down 4%. Again, both these are earnings reactions. 361 down about 3%. Varun Beverages 3% lower. So there are specific names which are under pressure even from within the liquid universe as we speak right now. Dharmesh, within banks, would you say the comfort is with PSBs purely because of the valuation? Or do you sense that they are also earnings re-rating candidates?
Yeah, I mean, both valuations are definitely comfortable for PSVs. And the reason being why the valuation was discomfort was because first thing, the credit growth was missing because of the asset quality concerns. So they have addressed that quite well, and most of the asset quality is at par with the best of the private sector banking play. At the same time, if you look at the growth numbers, they have been pretty aggressive, around 30-15% kind of a growth numbers have come through. And I have interacted with a few of the MDs of a couple of public sector banks, and now they have focused their entire foray into the retail space, and particularly on the personal loan and the unsecured credit growth, which was missing. Private sector banks were pretty aggressive out there. They were not public sector banking space. Now they have become. So our top pick out there has been Bank of India. It has rallied up quite a bit. But I still think there's scope for it to be reiterated to 1.2, 1.3 times price to book, which will be around 170, 180 time, 180 I mean 180 rupees per share price target. So there's been a structural shift into the PSBs, how they have been doing business, and that's the reason why we have been liking that. But from private sector banking space, I think Axis Bank merits a good, relook. This quarter, the numbers were pretty good, and the retail business has picked up, which was lagging 3-4% kind of a growth to 10-11% kind of a growth. And asset quality worsening is now, I think, on the backside. So from here on, they would be delivering a better set of numbers. Valuation wise, it's still cheaper compared to, say, ICICI, HDFC, or Kotex of the world. So banking space, particularly, looks pretty attractive, and with the corporate lending picking up, there's much more to go for them.
PSBs, Kunal, while we're talking about this segment, 52-week high coming in on Bank of India, all-time high on Indian Bank. Further potential on these stocks, if you're seeing any charts, any momentum on the charts rather?
Yeah, I think for many of the PSU banking names, I would actually expect another 3 months, 6 months, at least another 20% upside broadly as an overall pack for many of the PSU banking names. And I think what you're seeing is a classic structure shift for the entire PSU banking names, momentum coming back, the daily, weekly breakouts converting itself into monthly and quarterly breakouts for these stocks. The 30-40% odd correction from the 2024 highs, that getting absorbed for many of these PSU banking names in just a matter of the last 2-3 months of the price action. And I think, if I'm not wrong, May, June, somewhere, the PSU banking index was almost 20% lower from where it is right now. So in the last 2-3 months, it's been a stupendous recovery for many of the PSU banking names, and this generally happens when there is a new trend in the making for most of the stocks in the space. So I would be bullish on the entire pack. I think Bank of Baroda, Canara Bank, PNB, etc., something which I've highlighted earlier.
Okay. Let's move on, in fact, and since we're on the subject of banks, let's hear out what Canara Bank had to say about their guidance, their GNPAs, and of course, why Bandhan slid the way it did.
The growth will continue at around 13% continuously in the next 2 quarters also. But always just in a practice of the Canara Bank that we give the guidance, whatever the guidance, little conservatively, but we outperform that guidance. That's continuously last 3 years, the same thing is happening. But I am sure that we will grow in the current financial year around 13% credit growth. I am very much confident that by the end of the March, our gross NPA will go below 2%. Net NPA also may go below 50 even for the December quarter itself.
We have kept a guidance of credit cost for the EV or the microfinance segment at 2.5 for 2026-27. We are keeping that guidance. We have also kept a guidance of 1.8% for the bank as a whole for 2026-27. Currently, we are around 3.2. So we are not changing the guidance till now. We are hopeful that both in the EV segment where the NPAs are rising, it will be moderated, and definitely the slippages will come down. And so provisions requirement will be this. And in the secured books where we are almost in line with the industry trend with all the banks, the requirement of provisions will be much lesser. So keeping that, the guidance of 2.5% in the micro segment and 1.8% for the bank as a whole at the end of 26-27, we are keeping it unchanged.
Closing trades right here in ET now, and still pretty somber as we speak. In fact, I think for the week, if we can just bring up the over the week chart for the Nifty, I think we're going to close in the red. 25,750 is where we're currently at, but this week just mildly in the red, and I think that's got to be yesterday and today's doing. We're down about 111 points on the Nifty futures at that 25,920 mark, and the breadth also continues to remain under pressure as well. But Dharmesh, just wanted to get your sense in on the defense pack, because that's where you're getting a bit of a mixed review. Whether you feel there is still good investment opportunities, even after, the well-discovered space that it is, and, irrespective of the kind of perk up that we've already seen in the stocks.
Actually, it depends what is the time horizon you are looking at for the investment perspective in the defense space. So if it is like 5 years and ahead, or a decadal kind of investment, then it's just scratching the surface as of now. Because if you look at any of the defense companies, be it HAL, BE and all, they all are sitting at anywhere between 4x to 6x, book to bill ratio. So huge order book is there, and that there has been a structural shift into the defense companies. Earlier, they used to be servicing overall kind of a companies. Now they are OEM manufacturers. And as Indian offset partners goes away and Make in India takes place, so 64-65% will be manufactured in India next 3 to 4 years. And going forward, by next 10 years, the entire 100% of the component with technology transfer will be happening in India. So that opens a huge window for any of the major defense companies, HAL or BEL, case in point. And if you look at the valuation multiples, they're still not that high. I mean, 30 times, 32 times 1 year forward PE multiple, whereas compared to many of the new age companies, 200 times, 100 times PE multiple, they are trading on, and people are willing to pay for that, whereas profitability is not that visible. Here you have a clear path to profitability with stable, earnings and margin trajectory and order book in place. So I think if somebody is willing to wait for 3 to 5 years, any decline in defense companies is a good time to enter on the marquee names. And our topics here in this segment has always been Hindustan Aeronautics and Bharat Electronics. These are our top two picks. Wait for mid-cap companies to mature and come to at least $1 billion kind of a revenue run rate mark, and then even they may become a good opportunity. As of now, stick to the large cap ones in the defense, and Majgaon Dock, I forgot the name, from the shipbuilding space. These are the three picks which we have been, recommending our clients and investors to be invested into.
So that's the take on defense. Dharmesh, coming to you for your take on metals. Over the course of the week, Nifty metal is up about 3%, second only to the run-up that we've seen in Nifty PSU banks. Your take on metals and the pockets within metals, ferrous, non-ferrous, or maybe perhaps precious metals, where would you be placing your bets?
So primarily it would be non-ferrous metal space, and metals is for brave hearts. I mean, somebody who trades day to day or 5 days, 6 days kind of a trading horizon, then there can be a problem because on down days they correct very sharply. But structurally they are into, structural strong bull theory. And because of the entire infra space picking up, why I have selected non-ferrous space? Because if you look at all the solar panels, EVs, and the new technology equipments coming to play, they are using more of copper, aluminum, and silver as a commodity for entire electrical transmission. Whereas steel prices have been muted, even domestic steel prices have not come up. The production has been more 12% kind of 9 months production has been there, as well as the consumption was only 9%, and China is seeing a degrowth. So maybe they may not be dumping of their steel products in India, but world is open for them, and there the steel prices will be benign and softer. So that restricts our export market for steel for most of the manufacturers. So I think that is one space. Prices have run up quite high. I mean, JSW, Tata Steel, all are trading at all-time high levels. So some profit taking out there, or they may see a time correction. But non-ferrous space like Hindalco, Hindustan Zinc, Hind Copper still deserves a re-rating, and I think the upside trajectory will carry on for a year or so. So we are penciling it around 20-25% kind of a stock price upside movement for Hindalco and Hindustan Zinc.
Okay, Dharmesh, thank you so much for your time. On that note, we'll let you go, but let's get into conversation with Siddharth Khemka, Head of Retail Research at Motilal Oswal, also joining us on the show. And good afternoon, Siddharth. Thanks so much for your time. Weigh in on your view on the markets. We've spoken about PSU banks, metal, but want your take on some of these chemical names. This is a sector that has been buzzing off late. If you branch out further into fertilizers, some good moves we've seen in the recent past, and case in point today being Navin Fluorine, a 16% uptick coming on that stock. Your take on the entire chemical fertilizer space, and are you seeing more momentum in the sector, or do you believe that it has seen all its good days?
Hi, good afternoon. Glad to be on the show. I think if you segregate, there are various sub-segments. Navin Fluorine came out with a strong performance across all segments. I think if you see majorly the three business segments for Navin, that is your the HPP, specialty chemicals, and CDMO. Strong growth continues in CDMO business, in the specialty chemicals. However, if one were to see the SRF numbers, that was a bit disappointing in terms of the overall growth. So a bit of mixed cues coming in from both the players. So clearly Navin has an upper edge. We believe that strong growth would continue. Valuations are a bit on the higher side. We had seen run up. especially if you look at the R22 chemical prices globally. They are coming off from the highs, and that is why I think some of these prices, the stock prices also reflected that kind of weakness. But nonetheless, you have to be stock selective in that space. So Navin Fluorine with the strong results clearly stands out compared to an SRF. In terms of fertilizers, I think a lot of developments happening from the government subsidy, the government support, as well as the global supply chain that is also getting aligned. Uh, Again, there we like something like a Coromandel International. They are backward integrating, which will improve margins, capacity expansion, plus something like a PI Industries, which is an agri inputs company. So these two stocks within the specialty chemicals and agrochemical segment is something that we like.
Hold on to that thought, Siddharth. Lots more to chat about, but for now, we're going to take a very quick break and come right back. Today, and sectorally, of course, it's the new age names led by Swiggy as well as Eternal, which are under pressure. Cement, technology, infrastructure, FMCG, all these sectors are weighing heavy on the markets today. But Amar, just wanted to get you in specifically on the charts for both Swiggy as well as Eternal, because that's where you're seeing quite an amount of pressure. In fact, Eternal is now down almost over 3%. What's the reading? Do you sense it could cool off further, specifically Eternal?
Yeah, so if we look at Eternal, what we are seeing here is that there is definitely some correction which is happening from almost 360 levels. The stock is down to around 320 odd levels. So this is going to be a very crucial area. So this week is going to be something very crucial, because if it stays below 320 levels, then it has a potential to rally or correct towards the 300 mark. So 290, 300 then would act as an important zone of support. And if you look at the trends and some of the technical indicators, they are clearly pointing that it's not going to bounce back in a hurry. That's very clear. So even if there's a bounce back, it would go in for consolidation. So I would say that if one wants to go for fresh entry, then that level is around 290, 300 levels. And from there, we could expect a bounce back. But the upside seems to be capped around the 330, 340 levels for Eternal in the short term.
Okay, so that's the take on Eternal and Swiggy. Amar, your picks, some of the closing trades that you would like to share with us?
Yeah, so I would like to first talk about Aurobindo Pharma. So if I look at Aurobindo Pharma, the stock has been, if you look at from a medium-term perspective, the stock has corrected from almost 1600 levels. Currently, it's around 1135 odd levels. It seems to have formed a very strong base and support. So the stock has a potential to rally towards the 1245, 1250 levels. So one can look at a buying opportunity for an upside target of 1247 in Aurobindo Pharma and a stop loss of 1067. And the second stock which I would like to talk is from the banking space, private banking space, and that is IDFC First Bank. This is one stock which has rallied from almost 70 odd levels, 68, 70 odd levels, currently around 81, 82. The structure of the chart is very strong and positive from a short-term, intermediate-term perspective. So this is one stock one can look at buying at the current levels with a stop loss of 76 and an upside target of 94.
Okay, so thanks for sharing your picks with us, Amar. On that note, we'll let you go. Thanks once again for your time today. Okay, just shifting focus and tracking some of the top buzzers today and the top laggards from the Nifty 50 group of stocks. Eternal, of course, we just spoke about that one, 3.5% lower. But pressure continues on Cipla too, after, of course, they've trimmed their margin guidance and there has been management change that has been announced at their MD and CEO level. Umang Vohra is going to be resigning. So that's Cipla. That stock is lower by about 2.5%. Kunal, your reading on Cipla and this 2.5% cut, does it make the stock more attractive to buy at the current price point?
It does actually. In fact, yesterday also we were discussing and I mentioned that 1500 is a good support for Cipla, and in case if the stock corrects to that level, it could actually be a good price point to buy the stock. So there are two metrics to bifurcate or identify the price patterns for Cipla. One is on the last 6 months time frame charts, and then compare this to 2024 at a point where many of the large cap pharma names I think have gone through a sharp correction. I think we were discussing Aurobindo Pharma some time back, from 1600 highs, the stock is, had gone back to almost 1050 odd mark. So like this, there were many of the larger cap pharma names which had gone through a 20-30% correction. But Cipla, on the other hand, was one of the very few large cap names, pharma stocks, which had actually come back towards previous 2024 highs around the 1600-1650 mark. So I think in that sense, there is a very strong relative strength or an outperformance which the stock had already shown with respect to the other peers. Then we look at the very short-term charts. The last 2-3 months where the stock has formed a base and then showed signs of rallies. Every single time the rallies, started off or the corrections ended off at a point when the stock retested 1500 odd mark. So give or take 10-15 odd points from those levels, I believe is a very strong support territory for Cipla in the near to medium term. And that's why I would believe that closer to this 1500 mark would actually be a point where traders could actually look at a contra buy on the stock rather than a sell.
Okay, that's the take coming on Cipla, which is a laggard today. But let's address an ET Now exclusive. And we understand that the government is likely to rationalize basic customs duty structure on machines used in the steel sector. Let me take it across to my colleague Prakash Priyadarshi, who's standing by with more details on what he's picking up from his sources right now. Prakash?
Well, we are learning from our sources that the government is likely to rationalize basic custom duty structure on machines used in the steel sector. A very significant development coming in. In fact, basic custom duty structure on machines likely to be rationalized to promote conversion of iron ore into different grades, which is currently in the range of 7.5 to 15% based on its uses. In fact, industry has urged the government to reduce it to 2.5%. To meet domestic requirement of iron ore. In fact, that will be very crucial to achieve 300 million ton of crude steel production by 2030. And therefore, government has initiated the process and held a meeting with the industry on this issue. Industry has requested government to address duties and compliance related issues. In fact, sources have also indicated that the government is planning to set up a framework for the effective implementation of BIS compliance. That is something which is very crucial at this point of time. In fact, sources are also indicating that the government has urged the industry to expedite the beneficiation process, which is very crucial for converting low-grade iron ore into higher-grade iron ore. And that will be very crucial to meet domestic requirement of iron ore going forward. In fact, this move is very crucial, very important and beneficial for the companies such as NMDC, Tata Steel, SAIL, already engaged in beneficiation process.
Okay, Prakash, thank you so much for taking us through all of those exclusive details. So some big news coming over there. But while we're talking about steel and metals, let's go across and listen into the word coming in from Gautam Shah, founder of Goldilocks Global Research, because he believes that metals will be buoyant for the next 6 to 12 months. He also sees the global case for hard metals to do well. Let's go across and listen.
Metals is known to be a cyclical space. It can give you a 2x, 3x, 4x, and then take away 50%. I think this has happened multiple times in the last decade. So right now, I feel that over the next 6 to 12 months, there is a case to believe that metals will come back. I think there is a global case for hard metals to do well. We saw that with gold and silver as well. And I think some of the base metals, copper, zinc, aluminum, nickel, all have very good, charts on the base metal itself. So metals, I think, is an opportunity for the year. I would not think too much long term. And many of these stocks are coming out of multiple years of consolidation. So upside is immense. Well, I think so far it's been banking. Banking has been single-handedly responsible for where the Nifty is today. Bank Nifty, as we speak, has been near lifetime highs. 58,500 has been a bit of a problem for that index, but I think that will also get crossed, and we are looking at 60,000 plus for the banking index. And I think all the top stocks led by the top PSU bank are setting up beautifully. So if the Nifty has to scale new highs, it will still be led by banking, followed by possibly IT, where I think most of the negatives are in the price and you could see a rebound. And Reliance at the upper end of the range, I think if that breakout happens, could also see further upside. But public sector banks, I think, could give out stellar returns over the next 6 to 12 months. You have to bet on PSBs. There's no doubt about it. That's the new mega trend.
Right, okay. Those are some trends that Gautam Shah from Goldilocks is actually spotting. But just looking at the market texture right now, while for the week we're closing in absolutely flat for ourselves, the start of the week, of course, and the handover from last week was much stronger. And then that rally has gotten fizzled out. Today, of course, it's really Bandhan Bank all the way, which has been the hard dent post its numbers. It's down almost 8.5% right now, or even Emphasis for that matter. We did chat with the management as well earlier today. I don't know if we can bring up those sound bites or not. That stock also tumbling by about almost over 4.5%. Nykaa also seeing some pressure, 3.6% lower for Nykaa. 248 is where the counter is. Eternal, 3.5% lower. But that said, the strength of the market, of course, is in L&T, Eicher Motors, BEL. Shriram has now perked up almost 1.5% after its numbers. And ITC as well is not looking all that bad, about 0.5% uptake after its earnings, which came by yesterday. But Kunal, let's stack up L&T and BHEL. L&T, of course, has seen a smart follow-through. But BHEL, the way it spurt up yesterday too.
Well, yeah, absolutely. And I think that's a very strong change of trend for BHEL and a much needed one. I think over the last 1.5 odd year, BHEL, which made a high around the 280-300 odd mark, went through a very sharp correction, almost like a 20-30% correction from those 2024 highs. And from there, the stock, was showing signs of very fragile or docile kind of charts, where the stock was just about trading into into a range, aloof from the market trends and not participating in the major part of the market rise or the rally. But then I think this brings in a very strong change of trend for BHEL. And with the inverted head and shoulder pattern now on the daily charts as well as on the weekly time frame, we could now be looking at much bigger targets for BHEL. And my sense is that we could now be looking at potentially say 280 to 300, which was the highs in 2024 for the stock. That could be something which I would keep an eye on in terms of the higher targets. Even for L&T, I think it's a very big breakout, almost like a 12-month of a major consolidation breakout for L&T. 3,800-ish was the high in 2024, and the stock made a low of around 3,000, 3,100 zone in mid of 2025. So I think from there on, we are seeing that the stock has recovered very strongly. It's back again about that 4,000 mark, and the momentum in the current month indicates that we could be looking at least 4,400, 4,500 as a target for the next 3 to 6 months for L&T. So bullish on this as well.
Okay, so that's the take coming in on a bunch of stocks, and Kunal continues to be bullish on L&T. So that over the course of next week, we are going to have numbers coming in from SBI. While the entire street is gung-ho about public sector banks, right now, you have the largest lender, the biggest lender that's going to be coming out with its numbers. And today, SBI and SBI Life both have perked up pretty well. And if I'm not wrong, they're at life highs too. Your take on SBI in particular, where do you expect the numbers to come, and how do you expect the stock to react once the numbers are out?
Sure. I think if you look at some of the larger banking names that have come out with strong numbers, especially the likes of ICICI, I think ICICI and SBI are the two banks in the larger banking space that have consistently reported strong numbers, improvement in NIMs that has been a key worry across the banking space, as well as the growth in both lending as well as deposits. I think asset quality for both remains pretty strong. And the SBI has shown one of the highest coverage ratio, provision coverage ratio in terms of the numbers that they have. Asset quality has been pretty decent, and we expect a steady quarter from SBI as well. So we believe stock should do well. We have a positive view on SBI with a buy rating.
Take on SBI, a positive view with a buy rating. 937 actually is where the stock has already climbed to. So quite a bit of move coming in there. Kunal, once again revisiting the metal space, and do you believe that any dip is a good buying opportunity here?
Yeah, not any dip, but a sizable dip. Ideally 5%, 7% correction is a good enough correction for metal stocks to chip in. And so, there are two ways to identify. One is that historically, when these stocks have come out of, say, a 1 year, 2 year, 3 year slump in the sense of price correction first and then a recovery board, how have these stocks performed? So I think in the historical context, many of these metal counters have given post the breakouts. So for example, 2020, Hindalco, Tata Steel, etc. went through a synchronized breakout, and that led into a multi-year up move for these stocks. And same happened in 2015-16 as well for many of these metal counters, and then in the prior decades. So I think in that sense, we are looking at a possibility that the metal stocks are potentially at a major multi-quarter breakout. Hindalco is among the top picks. I would sense even at current levels. The stock has been one of the leaders and the first ones to try and break past above the previous lifetime high levels. Tata Steel apparently is the second one, which has also done reasonably well. It's come back, I think till yesterday or day before, had come back towards 187, 188 kind of a mark, which again is a major multi-week, multi-month high for Tata Steel. SAIL has been a big surprise. The momentum in the last couple of days indicates that we could be looking at potentially levels of 150, 60 for the stock in the near term. So dips of, I think, 5%, 7% from their recent swing highs should be taken as a good buying opportunity.
Okay, that's the take coming in on metals right now. So what's your own opinion on metals and whether they look ripe for a continued spurt up, which they already have been seeing actually?
Definitely, I think the word for metals is turning positive across the street. Even we recently upgraded Tata Steel from a neutral to buy. We see that Tata Steel stands to gain from the improving steel prices realization, increased operating efficiencies, and a strong domestic demand environment. Plus, there are safeguard duties that the government has implemented for the domestic industry, for the Indian business. So that should be also looking up. Globally, I think there is a positive read through from what the US-China talks are happening, and there is a fair bit of expectation that at least the rhetoric will come down, whether there is a deal or not. But that should aid and that should be positive for the metal prices, base metal prices. And between that, I think we have already seen a strong rally in some of the other commodities like the likes of copper, zinc, aluminium. Now, I think the ferrous side is where we are seeing an uptick and stabilization in the global demand. On its own, I think Tata Steel has a very strong operating cash flows. They are looking at expansion without increasing leverage, so that there is enough balance sheet discipline that is leading us to giving an upgrade on Tata Steel to buy with a target price of 210.
So you continue to be bullish on the metal space, and Tata Steel is somewhere that where you've renewed your optimism as well, if you could call it that. Well, let's refocus and talk about the week to come. Lots of important cues to watch out for, starting from that OPEC Plus meeting on Sunday. You have auto sales numbers for us with PMI. It's a truncated week because next week is going to be a holiday on Wednesday on account of Guru Nanak Jayanti. Then on Thursday, when we come back, you have phase 1 of Bihar elections. So lots to watch out for. But other than that, if you talk about some major Nifty earnings on Monday, you have Titan, Tata Consumer, Bharti Airtel and Power Grid. Let's talk about one of those. Titan. Good set of numbers are expected this time around on a standalone year-on-year basis. Revenue is expected to perk up by more than 13%. EBITDA is seen to grow by 48.6%. So very healthy move on that front. Net profit is also expected to grow 50%, or rather more than that, because you did have that one-off base quarter impact of the custom duty reversal in gold prices. So that has slightly hampered the base. So this time the profitability looks rather inflated on the back of a weak base. But even if you negate that, net profit growth is expected at 14.5%, which is yet again healthy for Titan. Margins are seen sustainable at 11.2%. That is the guidance range that the company had given, so nothing to worry about there. Jewelry, estimated growth of 19%, healthy across segments. Watches, slightly muted growth is what we're expecting at 12% compared to what the street estimate is at 22%. Smart wearables are also down 23%. Eye care also slightly muted at 9% compared to the estimate of 14%. 9% is what the management has guided in their quarter 2 update. For emerging business, healthy move over here, overall growth of 37%. Fragrances, women's bags, the Tanera segment, all are expected to do well. It's the international business that is touted to outperform with an 86% jump on a year-on-year basis. So all in all, good set of numbers expected from Titan, of course, on the back of a weaker base. But nonetheless, they look good. When the numbers do come out, watch out for their commentary on gold prices, the buying behavior in terms of demand. Is it studded? Is it pure gold? Has the ticket size or the size of jewelry in gold reduced? Demand trends, profitability across segments, and competitive intensity and product mix are going to be very key to watch out for. So that's the take on Titans. Stock slightly under pressure today, right now as we speak, but good set expected on Monday. Kunal, your reading on Titan on the charts?
Yeah, it's really interesting. Last 2-3 months, 2 months of recovery for Titan. From 3,300, the stock coming back to 3,700, 800 mark, and now perched at a multi-month high already. And that too at a point where earlier gold prices had gone through a major rise. So I think in that sense, this is a very quick, very fast recovery for Titan, and the fact that the stock is just consolidating at the higher end indicates that we may be looking at the stock breaking out pretty soon on the upside. So my view is bullish on Titan for the near to medium term, and looking at the last 1-2 months of price recovery, I would expect the stock to head towards new highs and even to new ranges above 4,000 levels, potentially over the next 1 to 3 months.
Okay, that's the take coming in at Titan. Earnings awaited there. So that within the entire premium consumption pool, where is it that you find positive biases and stocks where you still have a buy recommendation?
So definitely, I think, as you said, consumption is a space that we are very positive on. A lot of triggers towards that, and especially on the discretionary side, I think the alcohol beverages is one segment where we believe strong growth is continuing. What we like is Radico Khaitan, which is our preferred pick there. I think we saw the numbers from United Spirits as well and Radico. I think the premiumization story in India, that is playing out pretty well for all the alcohol beverages in India. Globally, also some of these brands are figuring in the top 10 list of whiskeys that we are able to make. And the premiumization is not only helping improve margins, but growth, demand, strong demand. So that is something that we believe within the consumption space can be looked at.
Okay, so that's the take coming in on some of those names. But Siddharth, thank you for your time. On that note, we'll let you go. Kunal, you too. And we'll catch you again on Monday. But on that note, let's start winding down for the market. All in all, subdued day of trade coming in. An overall cut of 0.6% on the Nifty, 25,728 thereabouts is where we're touted to shut shop. Sensex to a similar 0.5% cut, with the India VIX spiking about 1%. Nifty Bank, that was doing well at open, is now under 0.5% pressure. So a cut of about 270 points on the spot basis on Nifty Bank too. From the Nifty 50 group of stocks, it's names like BEL, Shriram Finance, Eicher Motors, L&T, TCS, all of them doing well. BEL, in fact, up 4% on the back of good set of numbers. On the flip side, on the back of decent inline set of numbers from Swiggy, that stock is down. But because of that, you have Eternal, that's down 3.5%, and that is the top sectoral, top Nifty loser today. Followed by that, you have pressure on Cipla, NTPC, HDFC Life, Adani Enterprises, and Grasim, along with the Kotak Mahindra Bank and Hindalco. The advanced decline ratio has slipped in the favor of the declines, and that is what is causing the market breadth to be slightly weak as we speak. But all in all, it's only PSU banks that have ended in the green as we speak on an intraday basis, a 1.5% uptick. So that index continues to go from strength to strength. A 4% uptick on Union Bank, followed by Canada, PNB, UCO, Bank of Baroda, and in fact that entire segment has done very well. On the flip side, big losses coming in Nifty Metal. Vedanta on the back of a slightly weak set of numbers, followed by Hindustan Copper, Nalco, Hindalco, Tata Steel, SAIL, all of them under pressure. This followed by pharma stocks with Ipca Labs, Zydus, Biocon leading the losses. IT2, 0.5% down with Emphasis. That stock on the back of weak numbers are lower by about 5%. Coforge, OFSS, Infosys also trade lower. Nifty Bank, Realty, Nifty FMCG also closed in the red, with Dabur seeing steep losses of about 3%. Imami, Patanjali, Tata Consumer lower by 0.8%. Tata Consumer's numbers are out on Monday, so watch out for that as well. Nifty Auto continues to be on the flat line with Motherson, Bajaj Auto, M&M, Exide all looking under a slight pressure. But on the back of individual gainers and losers today, let's take a look at Navin Fluorine. That stock is up 13% on the back of a good show. Chennai Petroleum up 10%. Intellect Design, once again good numbers, 7.5% uptick over there, as is the case with IDBI Bank, a 6% uptick. Latent View, IKS Solutions, we interacted with the management as well today. That stock was up 5%. So all of these have been the top gainers from the Nifty 500 group of stocks, but intense pressure on Bandhan Bank on the other side, an 8.5% cut on that stock. Apar Industries, Emphasis, Motilal Oswal, Sapphire Foods is also down by 4.5%, as is the case with its QSR peer Devyani International, also lower by 4%. So these are some of the stocks that have not done well at all. Other than that, Shriram Finance, the earnings candidate today. Let's pull up that stock along with Maruti Suzuki and see where that stock has settled after the street have had some time to digest the numbers. A 2% uptick almost coming in for Shriram Finance. On the flip side, for Maruti Suzuki, that stock is slightly under pressure on the flat line 0.3% lower for Maruti Suzuki. But this is how we're shutting shop for the day, for the week. It seems like we've ended the week on a negative note on a week-to-date basis for the Nifty, because today alone we've seen about a 0.5% cut. But on that note, we'll wrap it up on today and this week's edition of Closing Trades. Thanks so much for tuning in. Stay tuned to ET Now for more news and updates.